Hello, I'm Steve Van Houten, President of Lifetime Financial Advisors. Welcome and thank you for joining us today for our third educational series. We are pleased to bring you timely, valuable content that will be impactful for your financial planning and investment portfolios. A special thank you to all the amazing veterans who have served our great country. We so appreciate your contribution and sacrifice. Happy Veterans Day. Today's presentation is sponsored by Putnam Investments, one of our valued investment partners. I know you will enjoy our speaker, Chris Hennessey, and thank you, Putnam, for your partnership with Lifetime. I'm going to introduce Dan Hamburger, Putnam's regional consultant, who will introduce our speaker today.
Thank you, Steve. Thank you for joining us today. What we're going to focus on today is really planning and the value of that, and really what's going on with the tax landscape. One of the things that happens with Putnam is that as an asset manager, we actually only work with financial advisors. And the reason is, and it's really simple, is that people need planning to do the best they can in their investments. So it's not really about the asset allocation or what you own. It's really about the plan that makes it most successful. If I could just share with you just one story. Dr. Daniel Kahneman won the Nobel Prize for economics, and he won this a few years ago. And he is an expert in behavioral finance. And behavioral finance is really just how we feel about money. And one of the reasons he won that Nobel Prize was he was able to mathematically prove that actually a dollar gained feels pretty good to an individual emotionally. But when you lose $1, it actually feels like you lost $2. And that's really behavioral finance. That's our emotions taking over in regards to money. That's why we think it's so important that you only work with a financial advisor to be able to do that plan and figure out the best path for you going forward. And everyone's different, but that plan accounts for that. Today with me to address some of the things we've talked about in regards to tax landscape and also the best planning options going forward is Chris Hennessey. Chris is a JD or an attorney. He is a tax attorney. He is a CPA and faculty director at Babson College in Boston, our hometown, which is actually one of the best entrepreneurial schools in the world. He is well-versed on planning, the tax landscape, and also what's happening in Washington as he works with our lobbyists in Washington to get the intel of what's happening on the committee, both in the House and in the Senate. So please let me introduce Chris Hennessey.
All right, thanks, Dan. I'm going to put the camera on myself. And Steve, thank you for having me, and thanks for honoring the veterans. I'm a veteran myself, and thank you all veterans that are out there that have tuned in. So I'm going to share the screen and put up a deck, which is right here. Okay, share, and there it is. Okay, and I'll put it on PowerPoint mode. Okay, great. So I'm going to do with you three things and probably go 25 or 30 minutes, and then we'll turn it back for some questions. One, just kind of understand where we've been, what's the current landscape, mainly what happened on Trump in terms of tax cuts, and then where might we be headed? There's a lot going on in the news right now about the Washington scene, and there's another bill that they're trying to get through, and I'll go through that, and then clearly discuss year-end planning strategies and so forth. So where we've been is a pretty good tax environment. In 2018, we started what's called the Tax Cuts and Jobs Act. Trump or the Republicans cut all the marginal rates, so the 39.6% rate became 37 and so forth, raised the dollar threshold amounts to get there, scale back some deductions. I'm clearly given, I am actually in California myself right now, going to talk about the SALT limit and the latest on that. Alternative minimum tax, if you know anything about that, it's not an issue anymore, really. And then the estate and gift tax, what about the future? Right now, we have a $11.7 million estate tax exemption, means anyone tuned in today can die with an estate of up to 11.7 million, probably be 12 million next year. But all these tax changes that Trump Republicans did will expire at the end of 2025, if not some of them before that. I'm only going to, on this slide about key figures, point out a couple of things, but I will set up a context here. So we have an infrastructure bill that just passed the House. It had already passed the Senate. 13 Republicans voted for it. 6 Democrats voted against it. They hadn't had those Republican votes, it wouldn't have passed. No tax changes to that. Now sitting in the House is a big bill. It started at $3.5 trillion. It's down to around $1.8 trillion now. It will presumably go through the House and then the Senate through reconciliation, meaning no Republicans will vote for it. They'll need all 50 Democratic senators to vote for it. And in the House, Nancy Pelosi can only lose 3 votes. Now, interestingly, originally, this bill would have increased taxes, would have changed what you see on this slide. That is off the table because of Kirsten Sinema from Arizona. She said, I'm not going to vote for tax increases, although she voted against Trump decreasing taxes, but now she won't vote for increasing taxes. So what you see on this slide is a pretty good environment. You know, top rate of 37%, capital gains rate, top rate of 20. That's going to stay. I'll talk about this net investment income tax. That may change a little bit. And notice the standard deduction, $25,100 for couples, actually $28,300 if you're 65 or older. What does that mean? It means that when you add up your deductions, which most of you is going to be the $10,000 limit on deductibility of state and local taxes, charity is the second one, and maybe some of you have some mortgage interest, they're capped at $10,000, as you can see in the slide. And then the rest of this I won't go through. So this is the state and gift tax. Not going to change. So we're going to change this. We're going to take that 11.7 down to probably 6 million beginning next year. That's not going to happen. It's actually going to go up to about 12. You can see the rate. Do be aware, folks, that in 2026, if something doesn't change before then, that 12 million will become about 6.5 million. So that means a married couple could shelter 12, 13 million. So if you're approaching that number, you have to think about advanced estate planning. And portability means that if I die and I haven't used up my 11.7 million this year, it carries over to my wife, not automatically. And you want that to happen. You want that to carry over to the next spouse. So this is kind of interesting. And we got away from this during COVID because everyone's focused on PPP loans and surviving. But what the Secure Act did, it raised the minimum distribution age, which we all have to take money out of our retirement accounts at some point. Used to be age 70 and a half, but it raised it to age 72. And it also allows you, if you have income, to continue to contribute to an IRA past age 70 and a half. Now, here's the bad news. It's the bottom half of that slot. So it used to be that I'm going to leave my IRA account to my wife or vice versa for her and me. But then after we're both gone, we leave it to our kids. And it used to be that those kids could take out a little tiny piece every year until they die, based on their life expectancy. That's gone. Now those kids have to take down the entire account, whether they inherit an IRA account, a Roth account, a 401k plan, by the 10th year after the death of the account owner. They can wait until the 10th year. They can take a little bit every year or whatever they want to do. So stretch is gone. So you really have to think about that. We'll come back to planning for that a little bit later on. We may see these changes. Secure Act 2.0 would increase the RMD age to 75, catch-ups, PUCD, and so forth. I'll skip over that now. So where are we now? What's going to happen? Well, we got fiscal pressures driving the need for more revenue. You clearly see that on this slide. I mean, a $3.1 trillion deficit before all of this additional spending. A lot of government spending devoted to mandatory programs, meaning what? Social Security, Medicare, Medicaid, and then, of course, interest on the debt. Look at the Social Security Trust Fund. Going to be gone 2034. So originally, what is on this slide were some potential tax increases that actually, to a great extent, were passed by House Ways and Means. It came out of House Ways and Means, looked like it was going to happen in a vote in the House of Representatives. But then, as I said earlier, Kirsten Sinema said, no tax increases. I'm not going to do that. So they had to change course in the middle of the day, if you can bear that strategy. And the White House released a document that said, okay, we're not going to raise taxes. What we're going to do instead was a billionaire's tax. It was going to impact 700 Americans. Elon Musk didn't like that. Neither did some of those other billionaires. And it was really unpractical to administer it. So they backed off that. And they replaced it with a millionaire's tax. Now, I'll briefly describe it. It's not going to impact anyone. But income over 10 million bucks, you got a 5% surtax. Income over 25 million, you got an 8% surtax. So it's clearly targeting the wealthy. But everything else on this slide did not happen. Now, I know what's on your mind is this SALT limitation. So let me explain that and explain to you or state what I think will happen. Remember, people that make predictions are either clairvoyant or deranged. My wife, I'm deranged, according to her. So currently in the law, when you add up your real estate taxes and your state income tax, let's assume California, you can deduct only 10,000. They may add up to 40,000. You can deduct a flat 10. So there was a lot of pushback from moderates in the House of Representatives, I should say progressives in the House of Representatives, to change this. Late last week, it appeared as if the 10,000 was going to go to $72,500, a lot better, beginning this year for the next 10 years. Then that number became 80,000. And that's where it stands right now. So it could well be that that's what gets voted on in the House beginning this year, folks. I do not think that will be the case in the United States Senate. Bernie Sanders has clearly said we are now giving another tax break to the wealthy if we bump this thing up to 80 grand. So in fact, I'll give you the data. If you bump it up to 80 grand, 80% of the benefit goes to people making over 200,000. People making between 50 and 100 grand get zero benefit, zero, because they take the standard amount that I mentioned earlier. So I think in the Senate, they will keep maybe the 80,000, but they'll put an income guardrail on that. They'll say, okay, you get the 80 if your income's under 400,000. I'm just kind of making up the 400, but it's probably going to be close to that. And if your income's over 400,000, your 80 begins to scale down. We'll see what happens, but I did want to mention that. So those are some of the increases. Now let's spend the rest of our time on actionable planning strategies. I want to talk about deductions, lower tax brackets, the Roth conversion, step up, and the Secure Act a little bit more. This slide's kind of complicated, but here's what's going on. You got a husband and wife, and they're giving away $10,000 annually to charity, and they have other deductions that include the $10,000 SALT amount that I just mentioned and $7,000 for mortgage interest. So if you add those three items up, 10 plus 10 plus 7, you're at 27,000, and they're a 22% bracket. So they can't get over the standard amount. But if they bunch their deductions, meaning don't give 10,000 to charity for the next 3 years, give 30,000 this year, and no gift at all for the next 2 years. If you read down the very bottom of the slide, that's going to result in a difference of tax savings of about $19,200 over that 3-year period. That's a lot of money to save. So I think this is a good strategy, and you could double up instead of, in this case, tripling up. And you can also do this through a donor advisor fund, which your financial advisor can help you with, because that way you could give the 30 this year, but that donor advisor fund wouldn't have to give all 30 away to charities this year. They could give 10 this year, 10 next year, and 10 the following year. So this is just the lumping of charitable gifts to get over the standard amount. Now, this next one is a very interesting deduction. This is permanent law. Some people call it the QCD, which means qualified charitable deduction, but you have to be 70 and a half or older. That's kind of confusing because the minimum distribution age for taking money out of your retirement accounts is now age 72. And you must send a distribution directly from your IRA account. It has to be out of an IRA, not a 401k plan, to a qualified charity, a public charity, not a donor advised fund, not a private foundation. You can do this up to $100,000 a year. Now, a lot of people were actually using this to do their required minimum distribution when that age was 70 and a half. So, maybe I have a $25,000 required minimum distribution. I say, okay, that $25,000 is going to go to public charities. So I pull that money out of my IRA account. It goes to public charities. I've satisfied my RMD, but I didn't pick up one dime of income in my tax return. So look at the benefits of this. It could lower the taxation of Social Security. the Medicare premiums for Part B and indeed Part D. You look back 2 years, it's lowering my income, lowers my Medicare premiums, threshold for charitable gifts. And state of California, I don't think they allow a charitable deduction. So you're in effect getting the benefit of a charitable deduction because you're lowering your California income. So this is definitely something that you should use, called Quick QCD. Now, this moves us into the Roth. So let me back up a step. The Roth IRA is a tax-free account. In other words, the money in there is after-tax money. You can get money in there by contributing to a Roth or converting other retirement funds into a Roth. So it's a nice thing because it builds up tax-free, and husband and wife never have to take one dime out of the account. There's no requirement at age 72 to take money out. When your kids get it, they do have a requirement to take money out. So this is kind of showing you tax brackets and different income rates for 2018 forward versus the previous year. And if you kind of look at that 250, that 24% that I'm highlighting right now, that's a pretty good area to do the Roth conversion. Here's the premise, folks. The premise is, and I'll give you another way to think about this. Let's assume I have 200 grand in an IRA account. And I think over time, my 200,000 will go to 500,000 in Bay. Well, if I don't do the Roth conversion, then someday that 500 grand is going to be taxed to me, my spouse, and my kids. If I do the Roth conversion, let's say this year I pick up 200,000 of income, and I got to pay the taxes on that. But I'm going to have to pay the taxes anyway. The difference is that the 300,000 of growth in my example is off the table, never gets income tax. Now, this is going to be beneficial to anyone who thinks in the future their tax rate will be the same or higher than it is today. For those of you maybe a bit younger, that's not easy to determine because you might be in a 30, 35, 37% bracket today. The tax rate's really going to go up? Maybe not. Everyone says they are because the country needs to raise revenue to pay the debt and so forth. But you know what? Trump cut taxes. He cut the tax rates. How did he do that? He broadened the tax base by eliminating effectively the deduction for state and local taxes. So you could widen the tax base. You could increase Social Security taxes. You can increase the Medicare tax. So it's a tough bet. I think if I had a $3 million IRA, I'm not going to convert the whole thing. That's a lot of income to pick up. I might convert some of it, and I could spread out the conversion amount every year because the key tactically is try to top off the buckets. So if I'm in a year, well, okay, I can do a little bit more conversion to bring me up to 250 and stay within that 24%. I don't want to jump up to 32%. That's an 8% jump. That's a big jump. So that's the way to think about the Roth conversion. We're going to do a little bit more on that in a second. And this is what I just said. Roth 401k contributions also can make sense. So if the company you're working for offers that, make sure you max out any matching on regular 401k, and then you can put some after-tax money into the Roth 401k. And there are some interesting ways to fund the Roth accounts. And one of the ways that business owners can use, if a business owner lost money, a lot of people in the hospitality industry last year lost money, that's called a net operating loss, and that can be used to offset the income from the Roth conversion. That's a no-brainer. Absolutely, that's a great strategy. So let's talk about some estate planning, and then I may look back into a couple more things in the Secure Act. Obviously, a lot of people are under 11.7 million. In fact, I'll give you an interesting stat. There's only about 3,000 deaths every year where the size of the estate is greater than 11.7 million. But some of you may be closer to, if this thing comes down to 6.5 million, to that number, or if you're married to 13 million, then you are to 23 or 24 million. So be careful of that. California does not have a state death tax. Many states do. Where I live in Massachusetts, there is a state death tax. And review any documents, including trusts, that you have to make sure they're up to date. If you really have a lot of wealth, then you've got to do gifting now, because you not only want to use up your gifting, your 11.7 million, because you get that out of your estate, plus all the future growth on that number between now and the time of your death. And watch out for that sunset of the law, as I mentioned, going into 2026, where, at least the way the law is written now, that 11.7 is going to come down to about 6.5 million. I say about because the way they've defined it, it's 5 million index for inflation from 2017 forward. So those are some things to think about. This kind of shows you, okay, we're up at 11.7. We got an additional $6 million exclusion. And if you look at the growth on that, if you made a gift over 20 years at 6%, that's 19 million bucks. You know, 40% estate tax rate, that's saving 7.6 million. But of course, you got to have some wealth to do that. Now, this is important. This affects a lot of people. And the issue is that once the second spouse dies, the kids get the IRA. And they got to take it out by the end of the 10th year following death. They can't stretch it anymore, as that first bullet point indicates. So let me give you an example to think about. This is the one I always use. I got 3 kids. 2 of them are school teachers, and they married school teachers, so their income's low. Their marginal rate's low. The 3rd kid is on Wall Street and makes a ton of money. And I'll make the example easy. I have $3 million IRA. Should I leave it equally to all 3 kids? No way. No way. I should leave it 50-50 to the 2 school teacher kids because they're in a low bracket. So if they wait until the 10th year to take it out, they're not going to pay as much in taxes. The 3rd kid who's on Wall Street, what should I leave him or her? I should leave him or her assets that I die with, like my home, like my brokerage account or other real estate, because all those assets get stepped up to fair market value at death. So let me give you a quick example on step up. So I got a piece of property that I paid $500,000 for, and when I die, it's worth $2 million. Well, I leave that to the son or daughter on Wall Street. What's their cost basis for tax purposes? It's not $500,000, it's $2 million, date of death value. That's good planning. Now, there's another issue that comes up, and it's down the bottom of the slide. I'll give you 2 points on this. And that is, okay, Chris, I have a kid, I got 3 kids, and one of my kids is a spendthrift, got problems, or she's got problems, and I don't want to leave the IRA account directly to that kid, so I want to leave it to a trust. That can be done, but the best way to do it today is what's called an accumulation trust, because you are really not subject to that 10-year issue. You could also do that by leaving the IRA to a charitable remainder trust, and the charitable remainder trust pays an income stream out to that kid I'm talking about. Those are advanced strategies. I'm not going to go through life insurance right now, but you should clearly think about life insurance if you have an estate tax issue. And this is a little bit more about estate planning. I'm out here in California. I always tell the story, Sonny Bono, I got you, babe. Hey, babe, I got no last will and testament. Obviously, he died in a tragic skiing accident. Probate can be avoided by the use of a revocable living trust. You want to avoid that. Healthcare proxy, power of attorney. I told a story last night at an event I spoke at about a good friend of mine, a lawyer. He died. He had no will. He had no healthcare proxy. He had no power of attorney. I'm trying to help his wife. We couldn't even get into money for her because he had no power of attorney. This is why he was still alive, but in really poor health. Make sure those documents are up to date and that you've got those basic documents. Now, I'll finish. This is just for business owners, and there is a deduction available right now for business owners. It's detailed on this slide, but in essence, it's a 20% deduction on profits. So if I've got a sole proprietorship, or I'm a shareholder in an S Corp or a partnership, I'm a partner of a partnership, and I pick up profits of 100 grand, I get a $20,000 deduction. There are some restrictions that are described in this slide. The one change that business owners should be aware of is they may get hit with these flow-through entities with a 3.8% tax next year that they're not paying today. So I'm going to close up and then I'll give it back, I think, to Steve or Luke for questions. But everyone has benefited from this lower tax rate environment. It looks as if what is going to happen, presumably in the next few weeks, is this tax act is not really going to directly impact a lot of you at all. Tax rates are going to stay the same, low. The capital gains rate is going to stay low. So they're going to try to raise revenue through millionaires and through primarily business owners. Do work with your professional, your wealth management professional, and do review where you're at with all this. So with that, I'll conclude and turn it back for questions.
Fantastic, Chris. Great content as always. I think there's so many different areas that we can unpack further. So for the audience, as we've done in the past, in order to ask a question, you can do so in 2 ways. One, at the bottom of your Zoom window, there's a Q&A button, and you can do a question via the chat feature. Additionally, if you want to ask a question auditorily, you can do so. There's a raise hand button down below, and we'll be able to see you and unmute your line in order for you to ask a question. So while we're waiting for questions to come in, Chris, I think as you touched upon, one of the biggest changes as a result of the Secure Act is the elimination of the stretch IRA. And historically speaking, that was one of the best kept secrets to be able to continue to build generational wealth. Are there any studies that you've looked at from a timing perspective? I've seen some cases where it's recommended that beneficiaries, especially if they don't need the money, they wait until the end of the 10th year to experience the most amount of tax-free accumulation prior to distribution and having one outsized tax year. Any thoughts there? I know every situation is a little bit different, but with this being new, just wanted to get your perspective on taking a tenth of it at a time versus lumping.
Yeah, so one thing you could think about would be, okay, I'm older, I do have a large IRA. My income's really low right now. I'll give you another example. We had a situation in Texas the other day where the client retired at age 62. Income really dropped, and they were going to delay taking anything out of their retirement accounts until age 72. So they had this 10-year window to do the Roth conversion because you're in a lower tax bracket. Leave your kids the Roth IRA because now, they can wait until the 10th year, but whenever they pull money out, it's tax-free. So that's one way. The second thing you mentioned is this 10-year window. Let's say it's not a Roth, it's a regular IRA. And then each year, review everyone's tax bracket. So if you think about it differently, I got 3 kids over 10 years, 3 times 10, they're going to file 30 income tax returns, right? So each year I want to look at every income tax return. What's their marginal rate? Should they take some money out of the IRA that year or not? So that's another way to think about it.
Got it. That's helpful. Sticking with the IRA conversation, and it doesn't look like any questions have come through quite yet. So again, we can raise hand or use the chat feature down below. Anything is fair game, whether it's financial planning, tax related. I know Chris has spent a lot of time keeping his eyes on DC, so I know we can pivot our conversation to the latest on Capitol Hill, but we'll encourage everybody to keep this as conversational as possible. But Chris, one more question as far as inherited IRAs are concerned. So when Generation 1 has their IRA and they're naming beneficiaries, oftentimes of cases with minor children, it makes sense to, we never want to have a minor child listed as a primary beneficiary because there needs to be, the courts get involved to appoint somebody to actually receive that distribution on behalf of the minor child. So I guess the question is, as it relates to the 10-year distribution rule, you mentioned the accumulation trust. There's also the pass-through trust.
Yep.
So everybody should consult with their estate planning attorney. But any high-level comments you can provide naming a trust as a beneficiary in the case of young children involved?
So let's quickly go through those. This pass-through trust, also called the conduit trust, means that the income comes out of the distribution has to come out of the IRA through the trust to the child each year for the 10 years. So that's bad. That's what maybe you don't want if it's spent through a child. Whereas the accumulation trust, the distribution comes from the IRA into the trust, but then really doesn't have to be distributed out to the child. That's what probably you want. And these can be much more flexible. So I think people that now have a pass-through conduit trust should at least have that reviewed by an attorney and make a decision about whether they should keep that or go to the accumulation trust.
Awesome.
Yes, and Chris, on that accumulation trust, when the money hits that accumulation trust, then that's a tax trigger. So does that trust pay the income taxes? Does it flow through to the beneficiary?
Yeah, good question.
Capital, but how do we deal with the taxation of that?
If the trust is drafted correctly and the beneficiary has a right of withdrawal, even if they never actually withdraw, then the income at the trust level is taxed to the beneficiary, even though they never take it out of the trust. And
So
Generally what you want, because a trust at about $13,000 of income is in the 37% tax bracket, which is what you don't want. But if the trust distributes the income to the beneficiary, we're looking at their tax bracket, which would be lower.
Got it. And
All right.
go ahead, David.
Coming in through the chat. So I've got a few for you. First off, can we get a copy of the slides? So this presentation is recorded, and we'll get a copy of the presentation, a link for the video out to everyone. And Chris, if you're willing, we'll see if we can get the slides as well.
Yep, no problem.
And here's the next one. This is a tougher one. So this client says the billionaire tax didn't go through. So will they have a millionaire tax? What if that doesn't go through? And you also mentioned businesses will be taxed. So will prices on goods go up?
Okay, so two questions there. The millionaire tax is now part of the White House proposal. I think it'll have to go through because it'll raise, I think, around $300 billion in revenue over 10 years. Again, it's only going to impact 22,000 Americans a year. It could impact you, though, if you sold a business once in your lifetime. That kicks you over the 10, or you sold a big piece of real estate once in your lifetime. Now, the second question about business owners, I'll just describe the example. Right now, a lot of S corporations, the business owner that owns it takes the salary out, reasonable salary, and pays payroll taxes on that. And then all the other profits are dividend, taxed at whatever tax rate you're in. That's what's going to change. That those dividend profits are not subject to any payroll taxes or any 3.8% investment income tax. Next year, the proposal, if it passes, if your income is $400,000 single, $500,000 married, you are going to get hit with 3.8. So effectively, a profitable S corporation owner, shareholders, are in 37% plus 3.8 or 4 rounded off. They're effectively in a 41% bracket. Many of these business owners are going to think about going from this flow-through S corp to a C corp. C corp is a separate taxable entity. What's the C corp rate? 21%, 20% spread. So that's going on right now. That's something the accountants are probably reviewing.
Very interesting. Great answer. Certainly some business planning right there.
Correct.
So.
Yeah, exactly. Yep.
Next question. This is going back on the estate side. Please advise of inheritance tax on an estate valued at $7 million now with Biden's forthcoming tax law. What would the impact be?
So 7 million now, there'd be no impact. They're well under the 11.7, and Biden's not going to change that. Originally it was going to, but now it's not. However, if we go out to 2026, which is 4.5 years away, that 7 million will grow, right? So presumably in 2026, the exemption amount will only be 6.5 million. That person that wrote the question will be over that number. So they should be thinking about some estate planning, probably involving gifting, maybe 5 to 9 plans for kids, grandkids, and so forth.
One question that comes to mind on my end, Chris, I think in seeing a lot of the back and forth as it relates to tax rate increases, there's been a lot of focus on the corporate tax rate. Can you comment on the fact that, really individual taxation is really a bigger driver in revenue raising for the government than corporations?
Yeah,
and the actual effective tax rate for a lot of these large corporations is next to nothing.
Yeah.
Frustratingly so.
So a couple of points. You were correct. I don't remember exactly, but I think 3/4 of the revenue, the tax rate in the United States, comes from individuals, not corporations. But there are companies at the Apples, the Googles, who have an effective tax rate of like 7 or 8%. So in this proposal, they're going to get hurt. I'll tell you how. There is in the proposal a 15% minimum tax on corporate accounting profits, not taxable profits, accounting profits. 15% minimum tax. So that's gonna be additional tax that those companies will pay. There's only 200 companies because your income, your revenue has to be over $1 billion. So that's how they're going to go at it. Also, these companies, these multinationals, relocate, particularly intellectual property, to countries like Ireland, where the tax rate is 12.5%. Well, they can still do that, but they're going to get popped off at a 15.5% tax rate back to the United States. So that's not going to work anymore, right? So that's what they're doing to counter that.
Awesome. Awesome.
I got a comment. So Chris, we are very planning oriented, and we believe in like, what can we do today? Like, what do we know today? How can we have a plan of action or a call to action? And we find a lot of people believe they're in a higher bracket than they really are. I mean, nobody likes to pay taxes, but when we do an analysis in that bucket spread example you gave us,
Yeah, Steve, yeah.
that's very, very powerful. And
Yeah.
so we kind of want to help people fill these buckets up.
Right.
And I've been practicing for almost 40 years. 30 years ago, we never thought this way because when you and I first started, oh, you'll be in a lower tax bracket, deferred. No one thought America would be so prosperous that people it would work out so well for so many people. So it's really a blessing. So I just want to encourage us to take this action, do something. 10,000, everything's going to move the dial if we do something today.
Right. And I think what you're saying too, Steve, is I know you can do this at the firm. You can run scenarios for clients with certain assumptions on future tax rates so they can see the parameters.
Yes.
Then they can make a good decision. That's really important. And you're right. I think that most likely the tax rates will continue to be somewhere in the range they are today. I'll give you some background on the capital gains tax. Capital gains tax rate in this country has never gone higher than 28%. President Biden had proposed if you had over $1 million or more of income, your capital gains rate was going to be 41.4%. And never going to happen because once it hits 28, people do planning. They just hold on to assets. They don't sell them. So it's really good to be able to run these scenarios.
Yes. Yes.
Another quick plug for anybody who's got a question. You got the Q&A button down below at the bottom of the screen or the raise hand button at the bottom of the screen. Chris, I think that slide that you had that Steve was referencing showing the pre-Tax Cuts and Jobs Act marginal rates in 2017 versus the post-Tax Cuts and Jobs Act in 2018 and beyond. A conversation we have with all of our clients is the generationally low nominal marginal brackets. So it's a great opportunity to fill up these tax buckets.
Right.
We're huge fans of Roth IRAs, Roth 401ks. So I know in previous conversations with yourself and Bill Cass talking about the 3 tax buckets and needing diversification. Do you have any advice, for even some of our higher income earners who might be heavily tilted towards their pre-tax retirement bucket?
Yeah, sure.
We still advise those folks to participate within that Roth 401k because there's no income phase out.
Right. So a couple of things. One, taxes should never drive investment decisions, always the other way around. But if you think about the 3 buckets, we have a regular taxable bucket. That's our regular investment account. Some people call it a non-qualified account, or we may have stocks, mutual funds, and that account is going to produce interest and dividend income and capital gains income. And then we have a tax deferred bucket. What's in that? Our IRA account, our 401k plan is in that, and so forth. So eventually, those assets are going to have to come out once we hit the required minimum distribution age of 72. So that's why it's tax deferred. And then we have a tax-free bucket, which is your Roth IRA or your Roth 401k plan and muni bonds. That's your tax-free bucket. So we think about those buckets and diversification amongst those buckets, and also think about, okay, once we retire, if we have those buckets, where should we draw down from first? That's a different question.
Absolutely. And I think to that point, one topic of conversation too is, almost thinking about this chasm between when Social Security might start and when RMD age starts for age 72 right now. So in a lot of cases, it may be advisable to start tapping the IRA, that taxable bucket sooner, just so we can have a good balance between all 3 of those buckets as we go.
Right, I agree.
And in this gifting thing, our practice, just how it worked out, we have many generations, like we're in the fourth generation, so we can go up the food chain, down the food chain, family legacy. So a lot of, grandma, grandpa who have assets that will eventually go to the grandkids.
Thank you, Steve.
Why
Yeah,
not help them fund a Roth IRA today?
yeah,
They
exactly.
can become good savers. We have a matching program. So we really encourage that
Right.
accumulation down to the grandchild level to help them become a better investor.
Yeah.
So
And the other thing I like with grandparents to explain is the 5 to 9 plans, because they can own the grandparents can own a 5 to 9 plan for the grandkids, but the grandparents totally control those funds. They can change beneficiaries. They can even get at the money. They pay a penalty, but if they needed the money, they can get at it.
Yeah.
And it's a poor person's trust. It can go on forever. You just change owners. And actually, from an estate planning viewpoint, if there's an issue like that $7 million case, the question earlier, I can use up my $15,000 annual gift tax amount times 5 years all at once. I can put $75,000 into a 5 to 9, and my wife can do the same. But I control the money. I can get it back.
Yeah.
So it's a great way to do estate planning without the need to have a fancy trust document.
Right. Absolutely. Absolutely.
I had a question, Chris, on the Roth IRA front, right? Going back to that a little bit, because that's been a major topic of conversation with clients. It wasn't that long ago where that conversion ability, right, had an income limitation associated to it, right? Well, maybe 10, 15 years ago, right?
Yeah.
Likelihood of that being part of the ball game again, and or no, or
Yeah.
what are your thoughts there?
Yeah, it's an interesting question, Brian. The other thing that changed was, or is, used to be you could change your mind on a Roth conversion. You could undo it, but you can't undo it anymore. But what you can do is a client, or the clients that are listening, or an investor, you can average in during the year. So maybe every quarter you do a small Roth conversion from your IRA account. And then towards the end of the year, when you know what your numbers are going to be for 2021 or whatever year it is, then you say, oh, gee, I'm in a low tax bracket. I'll do a big chunk at the end. Or maybe I won't do a big chunk at the end. I like that strategy.
Yeah.
I think one other thing we were remiss, we wish we'd have done more of, Chris, is looking back at the lows of March of 2020.
Yeah.
The opportunity to do some conversions in kind with deeply discounted securities and experience that appreciation in the tax-free bucket in the Roth. So paying taxes on a much diminished amount and then letting that rise up, come back into the Roth.
Right, correct, yeah.
If only we had a time machine.
One more question from the chat. This is, are profit sharing accounts subject to the required minimum distribution, the RMD, and how does that interact with your IRA?
Well, okay, so once you hit 72, David, assuming you're not working anymore, then you got to look at all your retirement accounts, the profit sharing account, the IRA account, and so forth, and determine the minimum required distribution. If you have more than one IRA account, you can choose which IRA account if you want to take that money out. But if not, with the 401k, then you have to take it out of the profit sharing plan actually separately. So that's the way that will work.
Yes. So you can't aggregate the IRA and the 401k.
Right.
RMD, you have to take them separately.
Right.
Right. And while we're on that same mode, as we race to the finish of our presentation today, a lot of clients, when they're retired, they maybe keep their 401k instead of rolling it over to an IRA.
Yeah.
Could you just high level talk about the pros and cons and what you can't do by a 401k, we call it a frozen 401k.
Yeah.
And with RMDs and gifting and all the strategies that we want to do.
Yeah, I think you're smart to roll it over to an IRA. And the reason is because you have more investment options in a self-directed IRA than you typically do in a 401k plan. From an RMD viewpoint, you're gonna, at 72, you're gonna have to take RMDs anyway, but there is something that's a very subtle difference. It's interesting. If clients have money after-tax money in a 401k plan, that is subject to RMDs at age 72. They have to start to pull that out. It's not taxable. They have to start to pull it out. but that is not the case with monies in a Roth IRA. So I think once you separate service, you should be rolling over your 401k plan after tax money into a Roth IRA.
Yes. Got it. I'll tell you, Luke,
I was gonna say one final curiosity, and if there's any last minute questions, we can get to those. But one curiosity, Chris, you mentioned in some of the current tax proposals, there's the possibility of the RMD age increasing to age 75.
Yeah.
So from perspective of the federal government wanting to raise funds, how does that seems as though that would be deferring their ability to raise. So
Yeah, that's
any
correct.
comments there?
Yeah, that's absolutely correct. It doesn't make sense to raise money, but they've kind of countered that by doing the 10-year payout. That's increased revenue. So they paid for that, basically, is what I'm saying.
Okay.
perfect. Sure. I tell you, Luke, we might even have an exception and actually finish early for a change. So why don't you last call, as we say.
Okay.
And another question.
Looks like we got a buzzer beater. David, I'll let you take care of this last question in the chat, and then we'll wrap things up.
All right, here we go. So any benefit to taking an inherited IRA distribution and funding them into another Roth IRA, or pulling that money out before the 10-year mark? So another inherited IRA. I guess,
Well,
can
actually,
you?
Actually, interestingly, David, once I inherit the IRA, I cannot convert it to a Roth. The only thing I can do is, if, let's say my dad died and he had a 401k plan and I'm the beneficiary, I can convert that to a Roth, but I cannot convert the inherited IRA. So I'm stuck.
Interesting. Can you say that one more time?
So if I inherit an IRA account, it's too late. I cannot convert that to a Roth because the owner had to do that.
Yes.
So inherit a 401k plan, then I can convert that to a Roth as I inherit it.
Right.
Very interesting. Good distinction. I didn't know that on the 401k side.
So lots going on in this area, but we just thank you for joining us today.
You're welcome. Thanks, everyone.
And Chris, direct from East Coast, West Coast, and we appreciate your great stuff. We'll get the slides to the folks.
Yes,
and,
I'll get you the slides. Yep, no problem.
Very, very timely. And as again, call to action. What everybody's on the call today, what can you do? What should we do together? How to be proactive and take action for what we know today. And we know today there's great things to do. So thank you.
All right, thanks, everyone. Good night.
Awesome.
Good night.
Chris, thank you so much. Happy Veterans Day.
Okay.
And we'll be in touch regarding Roth conversions here for the rest of 2021.
Exactly.
Thanks everybody for joining.
Thank you.